Hello everyone. In this last and final presentation on the Open Economy Macroeconomics concepts, we shall be discussing the endgame. That is, we shall see how this entire international trade complex scenario plays out. In the process, we shall answer the questions of is international trade always good for the economy? What are the pros and cons of international trade, and how does international trade actually affects the economy and its various participants, that is the exporting and importing nations. So a quick recap of the first two parts. We saw that at the beginning of international trade, it was a positive sum game for all the economies and largely for most of the players in those economies. Later on, especially in a fixed exchange rate regime, it started, that is international trade started to get less and less positive, as the rewards were more skewed towards the bigger players in the economy and also towards the exporting country. It's less stark in floating exchange rate regime as adjustments take place, but it is present even there as well. Also, the fiscal and monetary policy of importing country starts to lose their efficacy as it ends up benefiting the exporting country much more. So in this part, before we finally get into the crux of the situation, let's quickly see what happens when there are malinvestments in an economy, inside a closed economy, and the credit adjustment starts to take place. So let's say a person who has taken loan from the bank and the bank has given the person the loan. Now, because of economic slowdown and various other reasons, malinvestment has happened in the economy, and when the bank asks for its loan back, the person is unable to give the loan. So then what happens? The bank would then take up your collateral, right? And it would sell that collateral to some other participant in the economy, let's say a player B. So there's a wealth transfer that happens from person A to person B. Some credit is destroyed in the economy and deflationary pressure, at least to some extent, gets built up. Let's take the situation a step further, and let's say that the malinvestments in the economy are much more deeper, in which case the value of the collateral is insufficient to meet the value the bank has lent to the person in the first place. And so this time the help of the private investors is taken place, as the bank issues more equity, and so the value of existing equity holders decline, and in other words, there's a wealth transfer from this time from the debt and equity holders or investors as well, and more credit is destroyed. So in other words, the deflationary pressure is much more in this case. And finally, the third level. In this case, even the equity holders and the investors overall are unable to help out the bank. The stark malinvestments in the economy is pretty high. In this case, the federal government has to intervene, and they in turn buys equity in the banks and in some cases some companies as well, to prevent them from falling. And how they do that? Essentially using the taxpayers' money. And why are they forced to do it? Because otherwise the impact on economy will be huge, as the depositors in the bank or common people will lose a large amount of money, because the banks would be forced to write off a large part of its balance sheet, and that could lead to an economic crash. Now let's keep this scenario here and instead replace the federal government of US by China. The malinvestments, because of the domestic inflation in China, as a result of keeping that exchange rate constant is so stark and so huge that now the Chinese government has to enter and save its economy. And the prime way it's going to do that is by selling the dollar and its forex reserves, which are in the form of debt, US debt, and foreign equities, which will then decline in price. So the question is that the only option towards China? The answer is of course not. There are three broad options that China has. However, the option given in the previous slide is the best possible of those three options. Let's see what are those three options before China. Under option 1, China can increase its debt further and monetize that debt, a process that it has been doing till now. So what the option is, keep on doing the same process. Keep kicking that can down the road. However, what will happen? And it's not a very distant fantasy, it's very close to the horizon what we are seeing. What will happen? Because of that increased money supply, the demand will increase further. Increased demand can lead to even higher inflation, given what we are noticing that China is fast approaching, a behemoth like China is also fast approaching what we call supply limits in its economy. So it will have two options, either to increase its imports further and dwindle its dollar reserves, something that it has been trying to avoid, or given its supply constraints, accept this inflation and let the economy traverse into a stagflationary spiral or even worse. The second option is the option we gave in the previous slide, that is, reduce its money supply by selling down its forex reserves in the form of debt, forex debt, foreign debt, and foreign equity. That would put pressure on the interest rates globally. So interest rates would rise in foreign markets as well as in domestic market. This would lead to a slowdown in growth, no question about it. A slowdown in supply given the higher interest rates and a slowdown in growth. And as the money supply is also coming down, it would also lead to a decline in demand. However, given that there is also a slowdown in growth or supply and a slowdown in demand, what will happen to inflation is an open question. That is, will the demand fall? Will the fall in demand compensate to the fall in supply or not? Inflation would depend upon that scenario. We can't answer it right now. And the third option, China could reduce its money supply in two ways mainly. One, as we have seen in the previous slide, by selling its dollar reserves in the form of foreign debt and equities. Or it can also draw down its domestic debt and hence reduce its money supply. However, reducing money supply by drawing down its domestic debt can lead to a severe bout of deflation and can then amount to an economic depression in China, an option I'm sure certainly China would like to avoid. So one question that can come to your mind, and we have touched upon it briefly in the previous slide, is why can China inflate infinitely? Or in other words, why can China keep on doing the same thing, inflating its money supply domestically more and more and keep on rolling the ball further and further? After all, it can manage the public backlash even if there's a high inflation in the economy given its political structure. The answer is it can't. Economic gravity. And by that, what I mean? if one increases the money supply, that leads to an increase in demand. Even for the most basic goods, we have seen like food, basic materials, energy, the imports of Chinese imports have been rising gradually over the years. Domestically also, even for a country whose supply side spectrum is as vast as China, we are seeing the Chinese economy touching its boundary limits. So in other words, the supply side of China is reaching its boundary limits even as its demand is increasing. So what it would mean domestically and perhaps even internationally is that it can lead to a supply shock, which means more and more inflation, which can either be addressed through further increase in imports that actually would put further pressure on its dollar reserves, ironically, which it's trying to avoid, or rationing, literal rationing of its domestic supply. So the two options lead more inflation, leading to either rationing of supply or vanishing of current account surplus from China and pressure on its dollar reserves, which it's trying to avoid. So there are no good options. In any case, going down this route will put pressure on dollar reserves of China. There is no question about it. This chart is the current account as percentage of GDP of China, and as we can see, since somewhere in the middle of 1990s, early 1990s, the current account of China started rising, reached a peak, and then has started to fall. So the process is already on. Of course, extraneous shocks can accelerate this process even further and faster, but it will happen in absent of any exogenous shock. It would have happened anyways in its due course of time. The exogenous shock makes the process faster. So out of all the three options, option 2, as we can deduce, that is reducing the money supply by selling dollars, is the best option for China ultimately to go about. If it goes for option 1, it messes its economy even more, and ultimately the dollar reserves anyways dwindle. If it goes for option 3, as we saw, it will lead to a deflationary cycle and perhaps even an economic depression, something that no country would like to have. Hence, we can deduce that dollar is actually the chalice of life, or the bloodline for China in this case. And because this is what China needs to manage its domestic inflation, its supply and growth, investments, and even in global influence. And when I say China, by the way, because China is such a behemoth, I mean to say all mercantilist countries adopting similar kind of models. And that is why China has actually been keeping a tight leash on its capital account ever since. But it's increasingly becoming hard for the foreign companies to move large amounts of dollars outside China over the last few years. So to compensate for, as we have seen in the previous slide, how the current account of China has been slipping. So to compensate for the slowdown in dollar inflow from the current account, China is actually trying to increase dollar inflow through capital account. How it is doing that? By listing Chinese stocks in US markets, putting some influence and increasing weightages in various global indices, MSCI, etc., which are actually used as benchmark by various fund managers to invest in stocks and markets around the world. And as we have discussed in the previous slides, the global shocks make the situation worse and accelerate this process even faster, thus putting all these mercantilist countries and economies which are in a precarious situation even more perilous situations over the next few years going forward. So in conclusion, we can say that international trade in the given system turns from a positive sum game finally into a negative sum game. The final adjustment process could be brutal and arduous at the same time, as domestic supply in the importing country would take some time to build, leading to a decline in growth. Possibly, the inflation in the importing country can rise, though it would, as we have seen, it would depend upon how little or more the demand would remain constant, or in other words, how much of the demand is inelastic or elastic, and hence, inflation question is still open. In the exporting country, however, a deflationary scenario is on cards, with the fall in business and unemployment. If, however, any other route is taken, it can lead to a bigger catastrophic situation for the exporting country. So overall, international trade can remain a positive sum gain for longer if the complete free market practices are allowed to be followed, that is, no exchange rate manipulation. Even when there is a free exchange rate policy, like any economic and business cycle of international trade, the international trade cycle would also follow the same rules. That is, there would be rewards and there would be risks. There would be highs and there would be lows in the economy. However, if the markets are manipulated, as we have seen, then the cycle would be longer. Both positive and negative cycles would be longer, and the negative cycles would be pretty brutal and last for a longer time. So thank you very much for watching these presentations. Do subscribe if you like such content and comment in case of any questions. Thanks a lot.